Ladies and gentlemen, good day and welcome to Nippon Life India Asset Management Limited Q1 FY23 earnings conference call hosted by InCred Equities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for your questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jignesh Sial from InCred Equities. Thank you and over to you, sir.
Yeah, thank you, Michelle, and good evening, everyone. On behalf of InCred Equities, I welcome you all for this earnings call of Nippon Life India Asset Management Limited. On behalf of the management, we have Sandeep Sikka and Mr. Pratik Jain, CFO. And the entire management team of Nippon Life Asset Management. I'll now hand it over to Mr. Sandeep Sikka, CEO of Nippon Life Asset Management. Sir, over to you, sir.
Thanks. I think good evening, everyone, and welcome to our Q1 FY23 earnings call. We have with us our Chief Financial Officer, Pratik Jain, Co-Business Head, Sugata Chatterjee, and Ashwin Duggal, Chief Digital Officer Arpan Saha, and Fujikake-san, nominee of Nippon Life Insurance. Our detailed investor presentation and press release have been uploaded on the exchanges as well as on our websites. Before we take our questions, let me share with you some comments on the recent industry trends and our Q1 performance. This quarter has seen significant market volatility owing to the continued geopolitical uncertainty, high crude oil prices, increasing inflation, and weakness in currency coupled with FII outflow. In the past too, we have witnessed that global sentiment and local economic indicators had an impact on the Indian asset management industry. The industry assets declined marginally by 2% in this quarter after witnessing a positive momentum for 7 quarters. The decrease was mainly due to the fall in equity as well as fixed income assets, while ETFs rose. However, the secular trends in terms of investor additions continue to remain steady. The industry further expanded its base of unique investors, which grew by 1.6 million in this quarter, representing a 5% increase over March 2022. The growth in the investor base and consistently higher quarterly SIP flows indicate investors' preference for mutual funds as an avenue for long-term wealth creation. At Nippon India Mutual Fund, our priority is to be future-ready and capture the long-term opportunity. Our overall market share rose by 16 basis points to 7.40%. AUM increased by 16% to rupees 2,794 billion. At Nippon India Mutual Fund, investor interest remains our only constant. We added 1.3 million investors in Q1 and continue to have largest investor base in the mutual fund industry. We increased our share of industry's unique investors to 37% with a base of over 13 million investors. In line with the investor first motto and the prudent governance philosophy, Nippon India Mutual Fund is committed towards institutionalizing approach towards fund management. As on June 2022, no category of equity has more than 16% of the total assets. Majority of the funds are jointly managed and no individual fund manager manages more than 23% of equity assets, and that too is spread across funds which have other co-fund managers. Systematic flows are a stable and a key driver for industry's long-term equity flow. Nippon India Mutual Fund annualized systematic transaction book is at rupees 97 billion. Quarterly flows increased by 30% to rupees 23 billion. On a gross basis, over 383,000 systematic folios were added in Q1. Our systematic AUM rose by 7% to rupees 482 billion. 51% of our SIP AUM has continued for over 5% vis-a-vis 22% of the industry. Also in volatile markets, folios with lower ticket size have demonstrated longer vintage and better stickiness. 13% of our SIP folios have continued for more than 5 years as against the industry average of 9%. Today, Nippon India Mutual Fund offers industry's best suite of products in passive category. With strong growth in investors' passive asset, our ETF ecosystem is already in place and far ahead of its peers in terms of investor base and mindshare. In this segment, we manage an AUM of rupees 601 billion and have a market share of 14.1%. Excluding EPFO allocation, which goes to two specific mutual funds, we would be the largest ETF player in the country. Our gold ETF is the biggest fund in the category with assets of rupees 68 billion. Nippon India Mutual Fund share in industry's ETF folios goes to 60%. In Q1, we added over 1 million investors and account for 83% of the total folio additions in the mutual fund industry during this quarter. Nippon India Mutual Fund has 74% share of ETF volumes on NSE and BSE. Our ETF's average daily volumes across the funds remain far higher than the rest of the industry. Nippon India Mutual Fund always had an unwavering focus towards building a digital-centric business. With a futuristic vision and a clearly articulated strategy in place, digital has become one of the keystones of our long-term growth and sustainability. In Q1, digital platforms contributed up to 55% of our total new purchase transactions. Over 750,000 purchases were executed through digital assets, an increase of 25%. Nippon India Mutual Fund has a well-diversified and a nimble distribution base and a wide presence through 275 locations across the country. As on June 2022, we have over 85,500 distributors in panel with us. The MFT base rose to 85,300 with an addition of 1,200 distributors during this quarter. Now on our financial performance. For the quarter ended June 30th, 2022, the profit after tax was rupees 1.1 billion, a decrease of 37%. Operating income rose by 1% to rupees 1.7 billion. Operating profit as a ratio of average assets under management was 25 basis points in Q1 FY23 as compared to 28 basis points in Q1 22. In the past, the company has followed a consistent dividend policy. In FY22, NAM India declared and distributed the highest ever dividend with a payout ratio of 96%. Over the last 8 financial years, NAM India has distributed a cumulative dividend of rupees 34 billion. As we grow organically through our physical and online channels, we remain open to evaluate investments in strategic opportunities that add to profitability or complement our existing businesses and ultimately are in the interest of minority shareholders. As a signatory to UNPRI, we have already begun to integrate ESG aspect into areas of strategy, business operations, investment management, and governance. We have introduced a formal ESG framework in FY22 and have disclosed our vision and objectives and the progress in the annual update. Through a combination of responsible investing approaches of screening, ESG integration, and active ownership, we remain committed to build a resilient portfolio that will not only provide sustainable returns to our investors but also have a positive environmental impact and social impact. To sum it up, I would like to reiterate that at NAM India,
income has also gone down a bit. I mean, as a percentage of total this thing. So, has there been any change in certain structures of brokerage given out or commissions given out that have affected your earning income?
Samir, I'll tell you. If you just go and see, this is the complete accounting impact. If you look at the markets were almost at its peak. 4th April was the 4th April or 31st March was the time where the market was at its peak. And if you see, market has recovered significantly, but at the 30th June when the accounts were drawn, the market was at its trough. So what happens? This is a balance sheet event date. So you have to take the market impact. So when we were preparing our financials for the quarter of March, the valuation was at the peak. And when we were making the balance sheet for the quarter, it was the lowest end, and therefore, those has to be accounted in our M2M income.
Yes, but that still affects your yield on this thing. I'm saying your yield is down. So, any particular reason why the yield is down?
On the yield side, again, because of the mark-to-market impact on our equity schemes, obviously the realization in terms of equity yields were comparatively lower, because the equity assets have declined to the extent of MTM impact. And also, whatever we have seen, the growth into our assets have come into the, more low yielding assets, which is the liquid and the ETF. And that is the reason of the lower yield.
Okay, fine. Okay, I'll come back in queue. Thank you.
Thank you. The next question is from the line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah. Hi. Thank you for your question. Good evening, sir. So, sir, just wanted to understand, sir, if we look at the increase in total folios, so it has been driven by the ETF segment. So, sir, just wanted to understand the new folio additions on the equity side, and how has the trend been over the last 12 months?
I think from our perspective, I think broadly, as we have mentioned, the total, I think there are very high percentage have come in ETF. We have also seen 375,000 new SIPs getting added during the quarter. Again, ETFs, what we are seeing are new investors are coming, and in active, it's a mix of both new investors, whereas the existing investors are also going for top-ups. So, but I think what we'll do is try to give this, Abhishek will share with this information post the call.
Sure, sir. And sir, with respect to the operating expenses, so there has been a sharp increase in the other operating expenses sequentially. So, what were the reasons for the same? And sir, with respect to operating leverage, so apart from the increase in AUM, so what are the other levers for us to improve the operating to have a better operating leverage?
So see, from the last quarter, if you look at it, Q4 of 22, we had other expenses of 138 crores, which is now at 145 crores. So I would not call it as a sharp increase. There is a 7 crore increase in overall basis, and predominantly because if you look at last 2 years, we have not given much increment to our employees. This year, the last year was, from a profit perspective, was one of the best years for us. And therefore, we have given, inflation-linked increments to our employees. So that is one reason. Secondly, after if you are compared to the sequential quarter, what had happened is that, or corresponding quarter, I think, the economy has completely opened up now, and, business is as usual and normal. So there are certain expenses, related to that, which has gone up. And also the fact that, we have carried out certain marketing initiative, which you would have witnessed, both in terms of our television campaign as well as the newspaper campaign, which is, again, as part of our future readiness, and future investment for the future. So those expenses have resulted in this increase. However, we remain committed to continue to work and, operate this company on utmost frugality. And that has been our approach for the last, 3 to 4 years, and we'll continue to operate in that fashion. Also, one has to, importantly, as Sandeep mentioned in the call, that look, the way we have diversified in terms of our fund management, etc. We are geared up if the asset has to grow from here, even if it has to grow 1.5 to 2 times. then there are not significant investments or expenses would be required. And that's where the operating leverage will come into play.
Sure, sir. Thank you.
Thank you. The next question is from the line of Mithil from HDFC Securities. Please go ahead.
Hi, good afternoon, sir. Thanks for the opportunity. First question was around yield. So, there's a sharp drop in equity yields in this quarter, whereas for the other peers, and when we look at the equity yields for the other players, we have seen that, for them, the yield has sort of improved in Q1 after the normalization in the NFO environment. But for us, even in Q1, there's been a very sharp drop in equity yield. So if you could explain what's been the reason.
No, so there has not been a sharp decline. I would say that what has happened in terms of our overall yield, one, we have to see that some of our fixed income or the debt assets have now, we have seen shrinkage in the fixed income, and those money has come in terms of ETF as well as the liquid. So our market share as well as our overall composition is skewed towards. So while we have maintained our equity composition of 42%, but the debt which has declined has gone into ETF and liquid, and therefore there has been some change because of the impact of this composition. Also because of the mark-to-market impact, there has been an impact on the overall yield. As regards,
so because of mark-to-market, your assets go down, but ideally your yield should be going down, right? Ideally, the yield should improve if the absolute assets go down in the tier. So my question is around yields actually, because even if I do understand that the share of the debt has gone down, but even then the drop in the yield seems quite high. So on a sequential basis actually.
So if you see from our perspective, what we have been maintaining is that, look, we start the year anticipating what could be the cost likely to come in. So we preempt that expense now only. So what we have done is we have anticipated what is the likely yield which will be going to be the end of the year, and we start building up on that basis so that, in compliance with the SEBI circular, the brokerage remain within. So what has happened in the last few years, there has been a higher intensity of competition, and a lot of new money has come through NFOs, etc., and which has been at a significantly higher cost. Basis that what we have done is, we have pegged our realization basis the expected new inflows and the expected new cost. And basis that you see some decline in our yields on our equity assets.
So you are trying to say that our yields are actually charged. So from what I understand is that the yields are charged on a daily basis. So is it something that we are charging some estimated yield on our P&L?
See, because what we have to do is, as per the SEBI requirement, you have to charge when the asset grows up from here, obviously there would be decline in the realization. The third bit is that, look, from the overall yield perspective, the composition has been changing, and the composition is changing, and there has been both on the debt and the equity side. What we have seen is a lot of the new money has started coming on the passive side. So we have seen good amount of inflows on the passive side, both on the equity as well as fixed income side. So all of these are putting some pressure on the yield, and which we see that it is likely to continue for some more quarters before it becomes, or because of the base effect, it comes down. But more importantly, there is what we also expect that from here on, once the the yield curve moves to the reaches the peak, from there on, when the yield curve changes, or when the interest rate cycle changes, the lot of money will come into the long tenure and the credit side of the fund, and that's where once that will lead to the change in the asset mix again. So what has happened, there is a flight to safety at this point of time, and then again we have seen that when the money will flow into those asset class and those categories where we have a propensity to have iron money, I think you will see there has been an overall increase in the yields. So I think this is a cyclical nature, and we expect that the pace of the decline will go down.
Sir, I agree that with the change in interest rates, flows into debt will return. But my point is that on the equity side, I mean, for how long this pressure? Because when we look at yields on a quarter basis, it is very difficult to make out until when will this pressure continue to remain. I mean, for 1 year, 2 years, 5 years. I mean,
no, so
we're not able to.
So I'll tell you that, look, this from our perspective, since we do not completely participate in the way the competition goes ahead and share their fee income with the distributors, we have our own benchmark, and we continue to maintain our profitability, which will continue to do so. However, this we could not control was the outflows and the churn from the old asset to new asset. But what we have seen is the pace of that has significantly come off. So what from December 18 till about December 21, we've seen significant outflows from our schemes, and so there was a gross outflows which was happening despite getting a lot of AUM. There was a net outflows that has been now arrested, and we are seeing net positive AUM. Also the redemptions, the overall redemptions have gone down. So which means the vulnerability to those old assets getting churned has now come down significantly, and hence the impact going forward will not be significant unless we also start sharing a significant portion of our fees with the distributor. So there is one which was, and what we could do proactively to stop it is that not to share significant amount of our fee asset, and the second was the redemption which was beyond our control.
Got it. And sir, I mean, just one thing on the passive side, given that most of these new fintech companies are coming up with a plan to launch schemes on the passive side, what do you think? And given that these schemes are sort of quite easily applicable by the other AMCs, what sort of innovation do you see on the passive side going ahead, given that we are seeing good flows in this segment?
From our perspective, we clearly see, I think you mentioned the fintech. I think it's not only fintech. Clearly, I think India still remains highly under-penetrated. And I think more places is going to be more competition is going to go. I think from our perspective, I think more than innovation, I think while on one side we continue launching new products, especially on the passive side. I think on the active, we have already articulated in the past that we will not be launching new schemes for the sake of launching till the time we see they can be scaled up. On the passive side, we will have the launch of few schemes, but ultimately, like anything else, the key focus is going to be on execution. It's not just going to be launching a scheme. So I think we believe on the passive and the ETF side, we have the ecosystem in place, and I think we'll continue the strategy of executing. So I mean, it's new players coming, not coming. what competition is doing. I think we keep an eye on that, but I think our core focus is, I think what is best suited for the investor's interest, what is best suited for the portfolio, and we'll continue launching schemes based on that.
And could you help us with the schemes which are already there in the pipeline for the next 6 to 12 months?
Slide number 27 of our presentation. 17 of the presentation. I think all the entire details is there.
Got it. Thanks. That was all from me. Thank you.
Thank you. The next question is from the line of Kunal Thanvi from Banyan Tree Advisors Private Limited. Please go ahead.
Yeah, thanks for the opportunity. Yeah, so my question is again on, trying to understand, where Nippon India, stands in the, in terms of profitability, market share juncture, because if you look at equity and that in both the categories, we have been not able to, gain back the lost market share. The market share is either stable or we are continue to lose it. But at the same time, if you look at our yields, we are seeing one of the fastest, compression in the revenue yields compared to, peers, both listed and unlisted. So what's happening out there? Like, we are not, as we said, we are not participating in giving high commissions. Then also our realizations are coming down, and at the same time, we are not gaining market share as well. Can you help us understand the sharp fall in the yields, which, from say 4Q FY22, our revenue yield was at 48 bips. It is at 45 bips. The change in asset mix don't explain this kind of fall, right? We have seen this kind of change in asset mix in previous cycles as well. And if it is like, what are the, what's happening out there? Because at one end we are seeing losing yield, at the same time we are not seeing increase in market share. So if you can explain us, in how one look at market share versus yield, phenomena, because when you look at other AMCs, there's a clear, inverse relationship. You give more commission and get higher market share. But in our case, on both ends, we are on the, we are seeing pressure on the both sides.
So, Kunal, I think I'll give some initial comments and hand it over to Prateek. I think firstly, I think from our perspective, I think you talked about market share. I think we have seen a market share go for 5 quarters. It has been going up. Now, pace, which asset class, I think again I'll stay out of that right now. It's because it's already in the presentation. Do not want to repeat it. But I think the first comment that I think for 5 quarters back to back, the market share has been increasing. Number 2, I think again from our perspective, we clearly believe, I think when we talk of market share, even one of the most difficult things to execute in this industry has been retail. I think in the retail market share, our retail portfolio count market share, everything has been increasing. Having said that, I think I'll go to the last part of this thing. And different AMCs will have different strategy. One strategy we're very clear, we are not going to be doing any business which is going to be at a loss. The change that you're seeing is due to a product mix, number 1. I think in equity over the last 5 quarters, I think we have started seeing better inflows. I think with the improvement in performance, I think we are seeing the gross flows are getting better. The redemption has totally stopped. Clearly, we believe there's going to be a lag effect, and I think the composition of equity sets will increase further in the next few quarters. As far as the realization is concerned, Prateek, you want to take this one?
Yeah. So I think, I've already, spoken about the yield part of it, but, you are right that what has happened is the recent increase in the market share has come through the low yielding asset, which is passive and liquid. But what you have to see is the pace of decline of our equity assets. The net outflows which we were witnessing has been arrested. The kind of depletion in our equity market share which we were witnessing has done away. Obviously from since the time we actually started exiting our past group, and from there on till about last December 21st, if you see, we were seeing continuously outflows, coupled with some not so great performance. But if you now see it that our 1-year and 3-year performance has come up, and in the last 6 odd months, if you see, we have been able to arrest that decline. Also, if you see on the fixed income side, large part of the money which has gone out is, the FMPs, which we had. Obviously, those were time bound, and we could. So while we have got them back, much part of it, but that has come into the low-yielding assets. So, those assets have matured and they have come into us. And I think at the appropriate time, we will be able to migrate them to the higher yielding assets. Again, as Sandeep mentioned, for us, the philosophy has always been the investor first. And importantly, during these times, I think the best strategy for the fixed income side has been, to have on the shorter end of the curve. So large part of our assets, even in the fixed income category, has come into the shorter end of the curve. And therefore, so growth has come on liquid, ETF, and shorter end of the curve, the debt. And that has an impact on the realization. And importantly, we have been witnessing, decline in the equity assets, which has now got arrested. And we, in the last 6 months, we have seen, decent amount of positive inflows. We will like to build on that momentum, and going forward, we're likely to see that higher share of or higher market share in the equity asset as well.
Sure. Just a follow-up on that. One, if I get it right, the large part of the yield fall is because we are gaining market share in lower yielding assets. Second follow-up question was, if you can help me with, average equity yield that we had in Q4 of FY22 versus this quarter.
So we do not give individual breakup, of the yields, but largely, if you ask me, the decline, is in line with the industry.
Sure.
And if you see the schemes, various schemes, because, from our perspective, whatever distribution commission what we have been paying, it is, is lower than most of our peers. Also because of the mix of the large part coming through IFAs, our average brokerage is lower, and that is where we'll continue to do so. But what has happened is that, look, when I'm saying, and we are admitting that, look, we saw a lot of outflows. So a lot of the old assets which were higher yielding or which were at a low trail has been replaced by the new trail.
Sure. Got it. Thanks. All the best.
Thank you. The next question is from the line of Dipanjan Ghosh from Citigroup. Please go ahead.
Hello, good evening. Am I audible?
Yeah, please
Yes.
go ahead.
Yeah. So just one question from my side. If you can give some color on your wallet share across top distributors in the banking category or MFTs or national distributors, more from the equity flows perspective, as we see, let's say, in the last 1 or 2 quarters.
Yeah. Hi, Dipanjan. Saugata this side. I'll just share data from the last 2 quarters. Broadly, the equity market share flow, from a flows perspective, when it comes to MFDs, we are roughly around 7-8% of the industry. From a banking and the larger wealth counters, will be slightly lesser, maybe around 5-6%. The IFAs are, of course, highly high on market share, closer to 8-10%. And from a blended perspective, it will be around 6-6.5% as a company. So that's where we stand today. We have a very high SIP concentration. In the SIP flows will be close to double digit. That has incrementally gone up over the last 8 quarters. And hence our net sales has started becoming positive in the last 3 quarters. So that is the broad numbers what I can share.
So just to confirm, 7 to 8%, 5 to 6% was on the banking channel, 8 to 10% was on the MFT channel, 7 to 8% was on the national distributor or the large distributor channel, and on a blended basis around 6 to 6.5%. Is that correct?
Yeah. Our larger share of wallet comes from the IFAs.
Yeah.
Even in absolute terms.
So just maybe a follow-up on this 8 to 10% wallet share that you gave across the IFAs. If you can segregate your overall flows through the IFA or the MFT channel between, let's say, the top 500 IFAs versus the rest, and not maybe from last 2 quarters, but maybe, whatever trends you have seen, let's say, for the past 1, 2, 3 years out there.
See, we do not give, we do not comment on these granular data in terms of our engagement with the distributors, individual distributors, or group of distributors. But I think whatever disclosures are required and which is available on the industry, or the peers, that data is made available either through MP, or through our presentations.
Sure. That helps. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Akshay Jain from JM Financial. Please go ahead.
Hi, sir. Good evening, sir. So I have two questions. Number one, can you please share some broad range of yields across segments? Specifically on the equity side, maybe if you can give some color on what you are making on, say, the old stock versus what you are making on new flows.
No, so see, it's in the same range. Is about close to about 80 odd basis point. On the overall basis. What we earn 75 basis point on the the overall basis, I would say, on the equity assets. And in terms of the old one, again, it all depends, in which asset class, which category, at what time the investor has come in, But the good news is that, look, we have almost, almost 30% of our assets, which are more than 4-year-old now, which is actually, that all the money which could have churned, would have been churned by now, because you have seen the pace of churn has come down dramatically. So I think this is the assets which is there, which is continue to yield a good, yield for us. However, as we continue to grow from here on, the pie of this asset will keep reducing. And hence, there will be a pressure on the overall yield, but, from a competition perspective, this will insulate us, from the perspective that, our yields are not going to drop as much as compared to, because now that the, outflows have been arrested, the yield drop will not be as significant compared to some of the players who will continue to have this churn happening. And so the good news is that because, our fund performance have also come up significantly up the curve, that will also arrest the churn, and also we'll see some decent amount of inflows back into our equity schemes.
Understood. And about the range in debt and liquid and others?
So I can, share with you, even in the last 2 years, so though this shift of the debt assets from credit to, a more safe assets have started 2018 September from that ILFS issue. From that period, if you look at it, the average blended yield on the debt would have come off, for the industry as well as for us, close to about 10 to 12 basis points.
Understood, sir. So, and on the second question is on the tax rate. So, your listed peers have benefited, from two things. One, on the deferred tax, which has been reversed on, say, MTM losses, and number two, the benefit of indexation on the investments which they receive. But in Nippon's case, we are not seeing, any benefit on the tax rate side. So, any comment on this?
No, so see, what we do is, and we have commented in the past as well, that look, we create a ETR. So what is the effective tax rate which we would be there, not considering just this quarter, because, the accounting standard require us to anticipate. So we have not taken the impact. We assume that market is going to be flat for the year, and basis that we have accounted for the profit, and that's how we have calculated the ETRs.
Understood.
I'm able to make sense. See, what we are assuming is that whatever income we are earning, we'll continue to earn irrespective of this one-time mark-to-market impact on the equity scheme, because we assume the market will become flat so neither the appreciation nor the decline we are considering by calculating the ETR for the full year. And based on that, we are calculating, and therefore, if you see, The effective tax rate is about 25 odd percent, 24% something.
And understood. And what about the indexation benefit?
See, what we do is that, from our perspective, till the time we do not sell or we do not trade into that, we do not calculate any kind of long-term or short-term capital gain on our equity investments.
Understood, sir. Okay, fine, sir. Thank you. Thank you for.
Thank you. A reminder to all the participants to press star and 1 to ask a question. The next question is from the line of Krunal Shah from Enam Investment. Please go ahead.
Thank you, sir. Most of my questions have been answered. Just one question. What are the yields in ETF for us? Blended yields in ETF?
So ETF would be in the range of, we have, said in the past 11 to 12 basis point, and, which has remained that way.
Okay, done. Thank you so much.
Thank you. The next question is from the line of Mohit Surana from CLSA. Please go ahead.
Yeah, hi, sir. Sir, just on one of the previous answers that you gave on your share in gross inflows of various distribution channels. If you could also, if you have the data handy, you could also tell us your share on gross direct inflows, which is like non-distributed, and also your share on redemptions.
Mohit, apologies, but what I've been disclosing in our investor presentation, that is what we comment on at this point of time, because some of this is, the data we have not been sharing. However, as and when, we believe that, such data need to be, disclosed, and, we will definitely take up the lead and, start disclosing it. But at this point of time, we do not disclose the individual shares from particular segment, gross flows from particular segments, in terms of distribution. However, total distributed asset as well as, our share of assets from IFAs, bank distributors and national distributors has already been provided in our presentation.
Understood, sir. And the second question is with regards to the operating expense. Now, you mentioned in one of your previous responses that there is some increase on account of higher activity, etc. So, do we assume this is a kind of a new normal and a new steady state? And if there is any outlook that you want to share for the full year growth in operating expenses, that's all from me.
No, so see, if you look at it, from an employee expenses, all what was supposed to be, get accounted in the first quarter itself, because the increments and the provisioning, etc. If you've seen, we have been consistent and will continue to be consistent. So that has been there. So this will be the steady run rate, unless there is a significant change in our profitability. Based on that, if it is a good year, we may decide to share some more variable, or if it is not a good year, we may, which you have seen in the past, that we may work on our variable payout. So that is the one case. But that lever have always remained with us, and that is completely contingent on, what kind of profit we make. But at this point of time, on our anticipated profit basis, we have already provided at least, and we do not see a significant change in the numbers going forward. In terms of the other expenses, see, there has been marginal increase in terms of rather two broader reasons. One is the marketing spend what we did. I think we'll continue to invest into marketing because we are seeing good traction and our performance has been good, and I think these are the right time for investor to invest. So obviously we'll reach out. We have seen good traction of new investor coming in, and therefore we'll continue to invest into the marketing spend. And barring that, all the other non-discretionary spend, we'll continue to keep a tighter controls, and we'll try to see that how much we can squeeze out of it, or at least not let them grow from here on.
Okay, understood. And just a follow-up, do you foresee any seasonality in terms of spends across the quarter?
Well, as I told you, there are only two things which we have said in the past that we will continue to invest in the future. So, one is the marketing, given the traction and given, how our scheme continues to do and how we want to spend. So that is one area. The second area is the digital. We have seen, significant increase in the activity on digital. And that is one area we believe that, we will keep investing. But all these investments, while, as a part of conservative accounting, we account it in the same quarter where we spend. But the benefit of these, is likely to accrue in future as well. So, this is how you have to see. And the details of these expenses are also available, on our annual reports. So you can see that, how we've been, spending, and going forward also, these are the two areas, marketing and digital. That is where we believe, some higher allocation which may happen.
Understood. Thank you.
Thank you. The next question is from the line of Abhijit from Kotak Mahindra Bank. Please go ahead.
Hey, hi, good evening. I have one question. Of the new retail ETF customers that you're seeing over the last 1 year, would you have a sense of how many of these are starting their mutual fund investments through the ETF route, or these are largely sort of already existing investors and sort of now experimenting with an ETF product as well?
I think at this point of time, we may not have that kind of a color, but I think opportunity going forward where that to how to cross-sell, upsell various products. But I think very, very difficult to at this point of time give this answer that I think whether they are existing or new. But our strategy will be to cross-sell various other products to them.
Sure, got it. Thank you so much.
Thank you. As that was the last question for today, on behalf of InCred Equities, that concludes this conference. Thank you for joining us, and disconnect your